Hello and welcome to BD Boy Academy. Let's look into options. What is an option? An option is a contract that allows its holder an opportunity to buy or sell an asset at a specified price, also known as the exercise or the strike. They are financial derivative instruments. That means the price of the option is derived from the value of the underlying asset. All option contracts have an expiry date. Hence, the option must be exercised prior to or on the day of maturity given the conditions of the contract. There are two forms of options commonly traded on exchanges. The first one being a call option that gives the holder the right to buy the underlying asset at the strike price. And the second being a put option that gives the holder the right to sell the underlying asset at the strike price. It's key to remember that options give the holder the right to buy or sell. There is no obligation that the option must be exercised. To understand options in more detail, let's consider investing in a stock for $100 over a 180-day period. So we'll be purchasing the stock today and we'll be selling it off after 180 days. In the first scenario, we can have a stock price at after 180 days reaching $102, $102.62, giving us a positive payoff. In another scenario, the stock price could go even higher and giving us an even higher payoff. However, there could also be a possibility of the stock price falling and giving us a loss. Now, similarly, if you look over 9 scenarios, 15 scenarios, and even 20 scenarios, you can see that the payoffs would vary. So in all of these hypothetical scenarios, we learn that investors can be prone to losses over time as stock prices move at random. So let's consider these 20 scenarios for this video and imagine if there was a way to only exercise the investment in scenarios where payoffs are greater than zero. So this is what our payoffs over the 20 scenarios would look like, where if the payoff is less than zero, they wouldn't be exercised. Now, if this is possible, this would resemble a form of insurance provided to the investor against losses occurring on financial assets. So let's explore this in more detail. We have our payoffs occurring over the 20 possible scenarios. And let's see if an investor can receive insurance to protect themselves from losses during scenarios where the stock price ST after 180 days is less than the stock price S0, which is of today. So what we do is we'll rearrange these payoffs in ascending order from the largest losses being on the left to the largest profits being on the right. And we replace the scenario numbers with the stock prices that occur at each of the scenarios after 180 days. Now, if the investment is exercised only when the stock price after 180 days is greater than S0, then the payoffs will equal to the max of ST minus S0 or SC minus S0 or 0, which would translate to if the stock price ST is less than or equal to S0, then the payoffs are equal to 0 and the investment would not be exercised. And if the payoffs are positive, where ST is greater than S0, then the investment would be exercised. In that case, the payoffs would look like this. To add a trajectory to them, we can see that only the payoffs that are positive are visible in the graph over here. Now let's eliminate these bar plots and just have our trajectory and see, is it possible for the investor to choose to purchase the stock after 180 days only if ST is greater than S0? If that's possible, this is what the investor payoffs would look like across the 20 scenarios. Yes, this is possible because such an option exists in the form of a call option. Now, remember call options that they give the investor the right to purchase the asset at a specific strike price. And this only occurs if the investor desires to do so. So the investor has an option, hence the name, to purchase the underlying stock at the strike price if they desire. So if there's a favorable condition. So let's take the strike price to be $100, just for simplicity to continue with our example, where the strike price is equal to $100. Now, if the stock price ST is greater than the strike price, the investor will choose to exercise the call and buy the stock at the strike price and then sell it in the market at ST, which is higher than the strike price. And they'll receive a payoff of ST minus K. Now, if the investor is in a situation where ST turns out to be less than the strike price, then they will not exercise the option and receive a payoff of 0. So as you can see in this scenario, the investor is protected or insured by the option that if stock prices fall below S0 after 180 days, they do not need to purchase the stock by exercising the option, and they receive a payoff of 0. So therefore, the payoffs of a call option equals to the max of ST minus K, or 0. But do keep in mind that just because the investor is getting an insurance, this doesn't mean the insurance is free of cost. The price of the option can be viewed as the premium on insurance provided by it. So therefore, the profits obtained from a call option will equal to the payoffs minus the price. And this is what they will look like. So if you consider an option that has a price of $2, then you can see from the payoffs received, the price is subtracted to give you the profits. Now, if you consider the case for ST being less than K, where payoffs are 0, you can see that the investor has a cost of $2. So they'll actually make a loss of $2. This is essentially the price of insurance provided by the option. So we know stock prices move at random, and we were looking at a case for investments only in the scenario where exercising the investments only in the scenario where payoffs are greater than 0. But earlier we looked at purchasing the stock. Now, what if we're shorting the stock? So let's consider the same example. However, this time we're shorting the stock. And you can see that if the stock price after 180 days is greater than the current stock price, a loss has been made. And if the stock price is less than the current stock price, a profit has been made. So essentially, it's just been reversed from the previous scenario. Now, is there a possible insurance for shorting a stock in this scenario where only payoffs are greater than 0 when the investment should be exercised? So let's go back to how we did it earlier. So we have the payoffs provided from shorting the stock over the 20 different scenarios. And we can see that we arrange them once again. However, the arrangement is slightly different because on the left-hand side over here, we have our maximum profits, and on the right-hand side, we have our maximum loss. So we arrange them in descending order, and we replace the scenario numbers with the stock price after 180 days. Now, if the investment is exercised only when ST is less than S0, then the payoffs equal to the max of S0 minus ST and 0. So that means at ST being greater than or equal to 0, the payoffs will be equal to 0 and the investment won't be exercised. This is because we're shorting the stock. So this is what our payoffs would look like in such a scenario. We add a trajectory to it and get rid of the bar plots just to show you the payoff trajectories for stock prices over the different scenarios. Now, as you can see, for ST being less than 100, which is the initial stock price, the payoffs are actually greater than 0. So is it possible the investor could choose to short the stock after 180 days only if ST is less than S0? Yes, there is, and such an option exists in the form of a put option. Now, remember, put options give the investor the right to sell the asset at a specific price. So the investor could sell the underlying stock at the strike price K only if desired. So if in this scenario, only if the strike price is less than the stock price after 180 days, will the investor want to exercise. Sorry, only if the strike price is greater than the stock price after 180 days, only then the investor will want to exercise the put option. So in that case, they will sell the stock at K and buy it back at ST to receive a profit of K, receive a payoff of K minus ST. Now, if ST is greater than K, the investor will not exercise the option and receive a payoff of 0. So it's exactly what we had earlier, but in reverse because we're shorting and we're looking at a put option. So the put option payoffs are equal to max of K minus ST or 0. Similarly, the price of an option, just because it's providing insurance, is not free. That means the price of the option is actually the premium paid on the insurance provided by it. And put options, the profits of a put option, similar to that of a call option, equals to payoffs minus the price. And this is what our profits look like. So again, taking the example of the put option being equal to 2, you can see that in scenarios where the put option is not exercised, the investor actually faces a loss of $2, which is essentially the price of the option or the price of the insurance paid by the investor for, sorry, the price of insurance paid by the investor on the option. Now, just to summarize, we know that an option is a contract that allows its holder an opportunity to buy or sell an asset at a specific price, known as the exercise or strike price. All options have an expiry date. There are two types of options, the call option and the put option. Call options provide investors the right to buy, and put options provide investors the right to sell. The payoffs are for a call option a max of S minus K comma 0, whereas that for put options is max of K minus S or 0. Now, for the future, we can look at several styles of option contracts, such as European, American, Bermuda, or barrier options. We can also look at the price of the option and how it's dependent on the movement of the underlying asset. However, for the next video, I will look into payoffs and profits for the option writer. I hope you like this video, and please provide me with your feedback on how I can improve and grow this channel. Thank you so much.